Hey there, financial explorers! Welcome to our journey into the exciting world of investment. In this video, we're going to take a deep dive into 4 popular investment options: exchange-traded funds, ETFs, mutual funds, index funds, and individual stocks. Each of these options has its own unique features, benefits, and risks, and we're here to break it all down for you. So, grab a cup of coffee, sit back, and let's crunch some numbers. Remember, the world of investment can be a jungle, but with the right knowledge, you can navigate it like a pro. Before we get started, please remember that this is not professional financial advice. Let's get started. First up is the rad world of exchange-traded funds, or as the cool kids say, ETFs. Imagine these bad boys as a cool combo meal, offering instant diversification by holding a bunch of different spreading the out. They're like the ultimate bargain, being super cost-effective, low expenses. These guys are traded on exchanges all day, every day, keeping your money fluid. Plus, they're all about open communication, regularly dishing out what they're holding. And they usually have fewer capital gains distributions, which means less tax headaches. However, just like every superhero has weakness, have some downsides. It is sometimes difficult to automate ETF investment when buying and selling. Some ETFs might not follow their underlying index perfectly, leading to what we call a tracking error. And investors, have minimal control over individual securities within the fund. Now let's delve into mutual funds. Managed by experienced portfolio managers, these investment vehicles provide diversification by pooling together funds from various contributors. They have the added advantage of offering automatic dividend and capital gains reinvestment options. However, they are not without their downsides, as they come with an expense ratio. But fear not, there are several mutual funds out there with attractive low expense ratios to choose from. Yet caution is advised because they might charge you for selling shares within a certain time frame. And they also have a tendency to distribute capital gains, which could result in potential tax liabilities. Next up, we've got index funds, practically the unsung heroes of investing. Their management style is on the hands-off side, resulting in low expense ratios. You invest your dough, and they spread it out across a broad range of market indexes, giving you instant diversification. But they're not flawless. They're built to echo specific indexes, which means flexibility isn't their strong suit. They might not keep pace with actively managed funds during bull markets, and there can be minor mismatches compared to the actual indexes. Their goal isn't to beat index performance, but to match it. Some studies suggest that index funds outperform majority of actively managed funds and are easy to automate to dollar cost average on consistent basis. Not to forget, we have the final contender in our lineup: individual stocks, the mavericks of the investment world. Think of these as your personal, choose-your-own adventure in the ever-fluctuating stock market. Guess what? You're the boss here. You have the liberty to go full throttle on your beloved company or share your stakes across various different. However, caution is the key since it's a wild jungle out there. At times, you might just hit the mother lode, and on other occasions, well, let's just diplomatically call it a learning experience. ETFs, mutual funds, and index funds provide diversification, expert management, making them a suitable choice for investors seeking a wider exposure. But when selecting from these options, always keep your personal financial goals, risk tolerance, and time horizon in mind. Always remember, time in the market is more important than timing the market. Even if you are able to start with a small amount, consistency is the key. In coming videos, we will dive deeper on how to get started with each of the above options and more tips on stock market investment.